President Trump has signed executive orders that impose 25% tariffs on imports from Canada and Mexico, with a reduced rate of 10% for Canadian energy products, and 10% on imports from China. These tariffs, designed to pressure these nations to address border security, illegal immigration, and the fentanyl crisis, are now in force. While the primary goal is to protect American industries and consumers, the move is expected to trigger significant short-term volatility and potential retaliatory measures from affected countries. Key impacts and themes for next week. 1. Market volatility and consumer costs. Equity markets. U.S. stock indices have already reacted negatively, with declines seen as investors weigh the prospect of higher input costs and disrupted supply chains. Expect further short-term swings as companies assess how tariffs will affect their profit margins. Consumer prices. As firms pass on increased costs to consumers, sectors such as automotive, agriculture, and electronics may face price hikes. Monitor inflation data closely, particularly the upcoming US PCE and consumer sentiment reports. 2. Sector and supply chain disruptions. Industries that rely on cross-border inputs, such as the automotive and electronics sectors, are most at risk. Companies may need to reconfigure their supply chains, either by diversifying sourcing or by accelerating domestic production, though these shifts will take time. Energy and natural resources might see a softer impact due to the lower tariff on Canadian energy products. However, additional tariffs on oil and gas are anticipated later, so remain alert. 3. Retaliation and global trade tensions. Both Canada and Mexico have already signaled plans for countermeasures. Retaliatory tariffs or other trade barriers could add layers of uncertainty, not just in North America but across global supply chains. Watch for policy updates from these countries, as any escalation could further disrupt trade and add to market uncertainty. Actionable strategies. Investors should review portfolios for exposure to industries heavily reliant on imports from Canada, Mexico, and China. This may involve taking a defensive stance on stocks in sectors like automotive, electronics, and agriculture. With heightened volatility expected, consider tactical hedges such as options or reallocating portions of your portfolio into defensive sectors like healthcare, consumer staples, and utilities that tend to perform better amid trade disruptions. Key U.S. economic reports, including the PCE inflation reading, ISM indexes, and non-farm payrolls, will provide clues on how the Fed might adjust its policy stance in response to rising costs. In parallel, pay attention to trade negotiations or retaliation announcements from Canada and Mexico, as these will influence market sentiment further. Given that global markets may react differently to these tariffs, diversifying into regions less immediately affected, or those with supportive monetary policies, could help mitigate risks from North American trade disruptions. Final thoughts. With tariffs now a reality, the trade landscape has fundamentally shifted. Investors should prepare for near-term volatility as markets adjust to increased costs and potential retaliatory measures. By reassessing sector exposures, diversifying strategically, and staying nimble in response to economic data, you can better navigate the uncertainties ahead. Use the weekend to review your current positions and adjust your risk management strategies in anticipation of a dynamic week influenced by these new trade